What is going on, everyone? Hope you all are doing well, and in this video we're going to talk about 3 stocks that I own who are outperforming the stock market in one of the most difficult times ever. Over the past month, the indices have not performed great. The Dow is down almost 2%, the S&P is down over 1.5%, and the Nasdaq is up 1.5%. But in that time span, there are 3 stocks who have significantly outperformed the indices. I personally don't time the market, but because I was disciplined in my pricing, I was able to start building positions either right before they reach the bottom or right after. But with all that said, let's go ahead and dive right in. The first company I'm up on over the past month is The Honest Company. I do see tremendous gains in this company, and at these current prices, the risk is low in my opinion. Right now, the company has a market cap at around $300 million, and with revenues estimated to be roughly around the same amount, with profitability on the horizon, this is a no-brainer for me. And that's why I believe they're probably one of the best risk-reward plays in the stock market. The Honest Company is in a demanding sector, and even if we are in a recession, which I think many of us believe we are, this company is still going to be able to thrive in my opinion. They also have solid gross margins, no debt, and plenty of cash and cash equivalents. And one thing I've been saying since day one of 2022 is that investors are going to look for companies who are going to be profitable or are already profitable. And so for a company like Honest, who has needs-based products, good margins, no debt, and a good amount of cash, this would be a hard one to pass up if you're looking for a company to buy during a recession. We know people are not going to stop buying diapers and wipes, and so companies that will be able to sell their products during the recession, in my opinion, are going to be extremely attractive for large investors. Plus, on top of all of this, when we look at their growth, they've made several partnerships recently that I believe will be reflected more so in 2023. So for me, it's hard to see Honest really falling much more, but I will be prepared for it, especially if it goes back into the $2 range. But this next one is massively beating the indices, and it is carparts.com. I talked about this company almost a month ago, and man has it performed well for me. Car Parts over the past month is up almost 20%. And as much as I wish it stayed down so I can add more to my position, it's been a nice run up. So I'm sure you can figure out their business just based off of their title. But there are a couple of things that I really like about this company that still make me bullish moving forward. They sell all kinds of auto parts for car repair, maintenance, collision, and accessories for competitive prices. And this is only the start for this company. First, when we look at this industry, they do have some solid competitors like AutoZone and O'Reilly's. There's still plenty of space in the auto parts sector for these companies to thrive. And unlike their competitors, they do not use brick and mortar to sell their products, which will help on their profit margins. Also, when you think about it, if something goes wrong with the car, you may not be able to actually drive it to the location to get the part that you need. Especially after Amazon, we have figured out that companies do not need physical locations to sell their products. This management team is genius in the way that they have orchestrated this whole thing. Not having physical locations allows the company to have lower expenses because of less workers that need to be paid and facilities that need to be kept up, which ends up reducing supply chain costs. Also, their strategy allows them to send parts directly to consumers, and this could work for an auto repair shop or individuals working on their vehicles. Lastly, their warehouses are in prime locations, so they will be able to send their parts in a couple of days. Now, the total addressable market for carparts.com is about $300 billion, and they have less than 1% of the market share. The company generated $166 million in revenue this past quarter and had gross margins of almost 37%. They also had a positive net income and said that they are continuing to focus on profitable growth. So for a company that has a market cap of $450 million and is looking to have over $600 million in revenue for the year with profitability on the horizon, there are definitely some things that I love about this company. Given the times, there's starting to be a change in consumer spending. But despite these changes, no matter the current financial situation, cars will continue to need repairs. And I think this protects them from anything that could happen to the economy. This company has put themselves in a position where they are now able to store their products in multiple warehouses across the US to send to their customer in a short amount of time. And they are building a brand new facility in Jacksonville, Florida, which is scheduled to be operational in the near term. After the facility does become operational, the company expects to send 55% of the customers their parts in 1 day and 98% within 2 days. So they are definitely putting themselves in a great position to be a strong competitor in this side of their business. Now, one of the red flags I've talked about is their low amount of cash. And right now, companies require greater focus on cash distribution. Currently, they have about $25 million in cash and $5 million in revolver debt. They do have another $6 million in receivables, but this is still a lower amount of cash than many other companies would like to have on their balance sheet. However, on June 21st, they announced that they got into an agreement with JP Morgan Chase for a $75 million facility that could expand as high as $150 million. So this puts them in a really good position to acquire more inventory in a short amount of time without needing a lot of cash. But the one thing I'm really excited for that they want to grow in is their do it for me space. They will work with other repair shops to get the right parts sent to the best place for the lowest price. With the company basically becoming the middleman, sending their most competitive price products to the best overall repair shops, they won't need to pay mechanics. So that means less expenses, and they get to grow their brand awareness with the shops that they are currently working with, which I think many of us can agree that building connections is the best way to grow your brand. So I started buying carparts.com in the 6s, and I will continue to buy in the 8s. I don't mind being patient when building my position, because if it runs up quickly, then great, I can buy some other companies, especially given the fact that there are some large caps that are starting to hit prices that I would really like to start buying. And the last company that has had a significant run this past month is the one and only Palantir. Talk about going on a run. Palantir is up over 25%. This company might be tricky to understand, but basically they form contracts with other companies where they will receive their data, and then using their algorithms, they help companies determine what are the best things to do for their business. If this is a stock that you are interested in, I suggest spending a little bit more time than you normally would on understanding their overall business. But when we look at Palantir, there isn't any significant news that has come out for this company. Bank of America said that the company was a buy, but that's it. Over the past year, this company's valuation has been cut over 60%. The company is valued just over $20 billion, and they are projected to have over $2 billion in revenues for 2022. The company also reported a positive diluted EPS, but they are not profitable yet, which also brings up another caution flag. However, when it comes to a company like Palantir, we cannot value them based off of where they are now, but where they're going to be 5 to 10 years from now. Now, of course, it's really difficult to make this guesstimate, but when we look at the artificial intelligence and data analytics space, do you really believe that this is going to shrink or even stay the same in the next decade? There's just no way that this is going to happen. So the question should be, how much market share will Palantir get down the road? And based off of the partnerships they have not only in the US, but worldwide, I think it is going to be significant. When we look at the partnership with the US government, for example, they're continuing to grow revenues in that sector with another expanded contract that was announced about a month ago. Their US commercial business has grown exponentially, and I can definitely see this continue as more companies begin to see the importance of Palantir products. Plus, in an older video, I said that Palantir is setting themselves up for a huge opportunity, especially if we go into a recession. Commercial businesses will not want to buy products unless it is going to help them survive or thrive during a recession, and Palantir does just that. Looking outside the US, many countries are increasing their military budgets, which puts Palantir in a great position not only to gain instant market share, but also to bring more brand awareness to countries other than the US. If Palantir wanted to, they could be profitable right now, but growth is their primary focus, and we are seeing this with the contracts that they're getting. When you consider the amount of cash that they have on hand, the ability to turn a profit in a year, and companies needing to look for solutions to get through these difficult times, I can see Palantir having some massive growth over the next few years. For me, I'm just going to keep buying anytime this company is under $15. I have already built out a sizable position because it has been 6 months since I first started buying Palantir, and I was adding significantly when it went under $8, so I can really put my focus on other positions. And this is where I want to encourage you to be confident in your price points that you set. Because I was patient with my buys in companies like Palantir and Honest, I was able to buy significant amount of shares at low prices. So don't chase companies because they are good companies. Buy companies that have a great business model and are at good prices to buy them. I think many times, including myself, we try to buy companies because we like the business regardless of the price. But especially in a market like this where everything has gotten hit, we need to consider what the risk rewards are for these companies and truly determine what we feel are some of the best companies to buy right now. Because I didn't chase, I now have more cash to buy other great companies like Opendoor that haven't been on a significant run, or start a position in some of the larger caps that have gotten hit extremely hard over the past few months. So if you want me to talk about some of the large caps that I'm looking into, let me know in the comments down below. But those are some of the companies I'm in that have outperformed the market. Hope you all enjoyed this video, and if you did, smash that like button. That helps more people see content like this. And if you're new here, hit that subscribe button and notification bell. That way you are notified when new content comes out. Hope you all enjoy the rest of your week, and I'll see you in the next one.